Disclaimer. This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the Luxembourg Fundcast. Today we're doing a deep dive, really getting into the legal foundations of Luxembourg's financial center.
That's right.
Our mission really is to unpack the core laws, some recent updates which are pretty significant, and, the practical side of things. How do you actually deal with the regulator?
Exactly. The authorization, the paperwork, what gives Luxembourg that edge?
We're hoping you'll get some real nuggets of knowledge, maybe a few aha moments along the way.
Okay, so let's jump right in. Maybe start with two really critical sort of must-know facts that capture Luxembourg's approach right now.
Absolutely. And what's really fascinating, I think, is how these two recent laws perfectly illustrate this dual strategy Luxembourg has. Yeah. It's not just about ticking EU boxes. It's about competitive advantage.
Okay, so what's the first one? All right, first key insight, the law of July 1st, 2024. This one fully brings the EU's Digital Operational Resilience Act, that's DORA, into Luxembourg law.
DORA, right. We've heard a lot about that.
You have, and it's serious. It means strict new rules for all financial players on cybersecurity and managing their information and communications technology risk, ICT risk.
And this is live now.
Oh, yes. This isn't theoretical. Compliance, including mandatory incident reporting through the regulator's online portal, that's been required since January 17th, 2025. So it's very much operational.
Okay, that's number one. What's the second key insight?
The second is another recent one, the law of July 15th, 2024. This one's interesting because it does two things. First, it brings in the EU rules on non-performing loans, creating a new regulated activity for credit servicers.
Okay, standard EU transposition.
Yes, but here's the clever part. It also amends Luxembourg's very important 2005 financial collateral law.
Ah, the collateral law. That's a big deal.
A very big deal. This amendment reinforces those famous supercreditor protections. It makes it crystal clear that these protections apply even if insolvency proceedings are opened outside the European Economic Area.
Wow. Okay. So locking down a key unique selling point.
Precisely. Solidifying that advantage.
So that dual driver approach you mentioned, it is using EU requirements as a chance to boost its own strength.
You've got it. That's the core of Luxembourg's strategy. DORA shows it being a good EU citizen, implementing regulations efficiently for single market access. But the collateral law change, that's proactive, enhancing a unique national legal tool to stay competitive. It's smart using EU work as a springboard.
Okay, so to really grasp that strategy, we need to go back to the basics, the foundation. The 1993 law, right?
Exactly. The law of April 5th, 1993 on the financial sector. That's the bedrock. Everything builds on this.
And its main job.
Fundamentally, it governs who gets to play in the financial sector and how they practice. The absolute core principle is mandatory prior authorization. The agrément. The license, yes, from the competent authority. Article 2 is explicit for credit institutions, no license, no operation. And that applies broadly. It's the main gate.
Who falls under this? Banks, obviously.
Yes. Credit institutions are one main group, basically banks taking deposits, making loans. But the other huge category is professionals of the financial sector, PSFs.
PSFs, right. That covers a lot, doesn't it?
It really does. It's a very detailed category. You've got investment firms, think brokers, portfolio managers, advisors. Then specialized PSFs like domiciliation agents, certain depositaries, family offices, and even support PSFs IT operators, client communication agents to the sector. So
very granular regulation.
Extremely. That detail is key to the structured, trustworthy environment Luxembourg aims for.
Now, you mentioned updates. This 1993 law isn't just gathering dust, is it?
Not at all. That's what's really interesting. It's designed to be a living document.
How so?
Well, the official version you find on the CSSF website, that's the regulator, it's a consolidated text. It gets updated constantly. The current one reflects changes as recent as February 10th, 2025.
Wow.
And you'll see sections noted as being amended or even replaced by newer laws, like ones on payment services or other specific areas. Think of it like a tree trunk.
Okay.
The core principles remain stable, but new branches, new regulations can be added or old ones trimmed as needed. It provides stability and flexibility.
Right, that makes sense. So the law evolves, but who's conducting this orchestra? Who's the main regulator making sure everything works? That's the CSSF, isn't it?
Exactly. The Commission de Surveillance du Secteur Financier.
Yeah.
The CSSF, if the 1993 law is the bedrock, the CSSF is definitely the gatekeeper.
And their core mission for someone wanting to do business there.
It's multifaceted, really.
Yeah.
Established back in 1998, they act purely in the public interest. Their main jobs include, well, first, prudential supervision, ensuring banks, PSFs, funds are safe and sound, system stability. Then there's market integrity, keeping things transparent and fair. Also, consumer protection, handling complaints, education, and a huge one, anti-money laundering and counter-terrorist financing, AML-CFT compliance.
That's a big remit.
It is. And their significant organization, over 950 staff, very international, reflects the job they do. They also act as the National Resolution Authority if a bank fails.
And there's a European angle, too, especially for the big banks.
Absolutely crucial. Because of the European Banking Union, supervision for the biggest banks is shared with the European Central Bank, the ECB.
How does that work in practice? If I want a bank license?
Your application actually goes via the ECB's portal, the IMAS portal. The CSSF does the heavy lifting on the initial assessment, the detailed review.
Okay.
Then they send a draft proposal recommending approval, hopefully to the ECB. But the final yes or no comes from the ECB's Governing Council. It's a joint effort showing how integrated Luxembourg is in the Single Supervisory Mechanism, the SSM.
Okay, so it's a thorough process. For someone looking to set up, say, a new PSF or even a bank, what does that authorization journey actually feel like, step by step?
Rigorous is the word, but also ideally predictable. It usually starts, and this is important, with preliminary discussions.
Before you even apply formally.
Yes. The CSSF strongly encourages, almost requires, this informal chat. You present your project, get initial feedback. It can save a lot of time and effort later.
Smart. Then what?
Then the formal application, a full written dossier submitted via the ECB portal for banks, directly to CSSF for others.
Okay.
CSSF confirms they've got it, acknowledgement of receipt, and critically, they tell you if it's complete. That's when the clock starts ticking.
The timeline.
Yes. Officially, they have 6 months to decide once the file is complete. Then there's the assessment detailed review by the experts. And finally, the decision.
6 months from completeness. Is there an absolute deadline?
Yes. Maximum 12 months from the initial submission, whether it was complete or not. And here's a key detail. If you don't hear anything within those 12 months, it counts as a refusal. Silence is not golden here.
Right. So you need to be responsive.
Absolutely. The CSSF sees itself as enabling quality business, but also controlling quality. The whole demanding process focusing on substance, governance, transparency acts as a filter. It's about quality, not quantity, which ultimately protects the reputation of the whole financial center.
Makes sense. Let's talk about that application file itself. It sounds like the real core of the process. What exactly do you need to put in it?
It is comprehensive. You need to cover all bases. First, legal and corporate structure.
Right.
Draft articles of incorporation, charts showing the group structure, detailed info on shareholders, especially anyone holding 10% or more, the qualifying holding.
That's standard corporate stuff.
Yes, but detailed. Then the business plan. This isn't just a sketch. It's a full memo on your activity strategy, target clients, markets. And critically, backed by a 3-year budget forecast, balance sheets, P&L, regulatory capital calculations.
Okay, financials are key. What else?
Operational framework. Huge focus here, especially now with DORA. You need to describe your IT systems, data hosting, security, business continuity plans, cybersecurity strategy in detail.
DORA's shadow looms large.
It really does. And finally, the compliance framework. Your internal procedures for AML-CFT are vital, plus policies on conflicts of interest, handling customer complaints, remuneration policies.
So that's a lot of documentation. What about the people involved?
Yes, the who. The regulator looks very closely here. This is about being fit and proper. Key personnel clauses are critical.
Fit and proper meaning.
Good reputation, basically. Yeah. Professional standing. Management, board members, key shareholders, they all need to provide recent criminal record extracts, sign a CSSF declaration of honor, confirming they're trustworthy.
And experience matters, too.
Definitely. Professional experience. The people running the show day to day must have relevant experience, demonstrating they've handled responsibility before.
Right.
And then there's a specific Luxembourg governance rule, the two-man management principle.
Two-man management.
Yes. Day-to-day management needs at least 2 actual people, natural persons, with roughly equal powers. It ensures mutual oversight, a check and balance.
Interesting. Do they need to be based there?
They do. They need to be physically reachable by the CSSF, so they usually require residence in Luxembourg or the nearby Grand Region.
Okay, so documents, people. What about the actual presence in Luxembourg? avoiding shell companies.
Exactly. That's covered by the governance and substance clauses. This tackles the letterbox company issue head-on.
How?
You have to prove central administration and a registered office in Luxembourg, real presence, real infrastructure, real staff, not just a mailing address.
Makes sense.
You also need robust internal governance. A clear org chart, defined roles, proper risk management processes, identifying, managing, monitoring risk. Plus, independent control functions. Risk, compliance, internal audit.
Internal controls are key. What about external checks?
Yes, external audit. You must appoint an approved statutory auditor, a réviseur d'entreprise agréé based in Luxembourg. The engagement letter proving you've hired one is part of the application package.
Right. And finally, the money, the capital.
The capital base.
Yeah.
You need proof that the required minimum share capital is fully subscribed and paid up right from the start.
And that amount varies.
It does, significantly. It might be, say, 50,000 euros for some simpler PSFs, maybe 150,000 euros if an investment firm holds client money, but much, much higher for a full credit institution.
Okay, that's a very thorough checklist. Beyond these formal requirements, you hear about the art of the deal in setting up. How does negotiation work? What about costs, timelines in reality?
Well, negotiation in the legal sense before you sign contracts falls under Luxembourg civil law. There's a core principle of good faith.
Meaning, be fair.
Basically, yes. Be fair, transparent, don't mislead during talks. If you break off negotiations unfairly when they're very advanced, there can be consequences. You might be liable for the other party's wasted costs. It's called culpa in contrahendo.
Okay, good faith is implied. What about keeping things secret?
Confidentiality is also generally implied by good faith. But honestly, you really want a proper written non-disclosure agreement, an NDA, to clearly define what's covered and for how long.
Makes sense. And exclusivity, can you stop someone negotiating with others?
Not automatically. There's no implied exclusivity. If you want that, you need a specific time-limited agreement, often called a lockout agreement.
Got it. Now, costs. What should you budget for?
Two main buckets: regulatory costs and professional fees. The good news is the regulatory costs are quite transparent.
How so?
They're set by a public Grand Ducal regulation. So you know what the one-off authorization fees will be like, say, 50,000 euros for a new bank license or 15,000 euros for approving a new major shareholder.
Okay, predictable.
And the annual supervision fees are also published, usually tiered based on your size, like balance sheet for banks, or sometimes a flat fee, like 15,000 euros for a registered crypto VASP.
Right. What about the other costs? Lawyers, consultants?
Those are the professional fees, and they are variable, obviously. This is where the art comes in for the advisors accurately estimating the work based on the project's complexity and, frankly, how well prepared you, the applicant, are. More preparation usually means smoother sailing and potentially lower fees.
And that links to timelines, presumably. The better prepared you are.
Exactly. The legal deadlines we talked about, 6 months from a complete file, max 12 months overall, those are firm. But the real timeline, that depends almost entirely on your application quality.
So the preliminary discussions are key.
Hugely important. They save time. A polished file submitted after those talks gets reviewed much faster. A rushed, incomplete one, that triggers delays, endless questions, and you risk hitting that 12-month cutoff and getting an automatic no.
So the art of the deal really boils down to being incredibly well prepared and committed from day one.
Overwhelming competence, preparation, commitment. That's what the system rewards.
Which leads us neatly to the why Luxembourg question. Why go through all this? What's driving its success and what's next?
Well, success isn't accidental. It comes back to that proactive, dual-track legislative approach. Look again at those mid-2024 laws.
DORA and the NPL collateral law.
Right. The July 1st law implements EU DORA managing ICT risk, incident reporting via the CSSF e-desk portal now, resilience testing, third-party risk, essential EU alignment.
Right.
CSSF Circular 25893 gives more detail, but the July 15th law, while doing the EU non-performing loan directive, also takes that chance to boost the 2005 collateral law, strengthening its power, its legal certainty globally.
And that links directly to its unique selling points, the USPs.
Directly. This strategy creates the advantages. USP 1, the gold standard in creditor protection. That 2005 collateral law is world-renowned. Bankruptcy, remote security, fast enforcement, no court needed sometimes, triggers defined by contract.
And now confirmed even outside the EEA.
Explicitly confirmed by that July 2024 law. A direct response to ensure legal certainty after a court case, that's proactive legislation. USB 2, stability. rock-solid political and economic stability, a AAA rating from everyone. That predictability is priceless.
What else?
USB 3. Cross-border expertise. The whole system breathes international business. Second biggest fund center globally. Leader in distributing funds across borders. The CSSF knows how to authorize pan-European products. English is just standard business practice.
And the legal structures available.
That's USP 4. The comprehensive and flexible toolbox. A huge range of options. You've got UCITS funds for retail investors, sophisticated alternative investment funds or AIFs, very flexible partnerships like the Special Limited Partnership, the SCSP, which common law managers love.
So a very well-equipped jurisdiction. What's the future look like? How does it stay ahead?
By continuing this dual strategy. First, flawlessly implementing the next big EU rules. The new AML-CFT package is huge. Markets and crypto assets, MiCA, is coming.
Staying compliant at the EU level.
Essential, but also lobbying effectively. Industry groups like ALFI are pushing for a deeper European capital markets union, positioning Luxembourg as the place for cross-border savings and pensions.
And technology.
Big focus. Embracing fintech. There's joint work between the central bank and CSSF on artificial intelligence. The robust DORA implementation signals they want to be a leading, well-regulated digital finance hub, not the Wild West.
So it's about playing the EU game well, but always sharpening those unique national tools.
That's the essence. Leveraging EU directives like AIFMD and DORA, while doubling down on national strengths like the collateral law and those flexible investment vehicles. That combination is Luxembourg's enduring appeal.
Okay, as we wrap up this deep dive, let's quickly recap the 2 absolute key takeaways for you, the listener. First, DORA, the Digital Operational Resilience Act. It's fully law in Luxembourg now. Compliance isn't optional. Your ICT risk management, testing, incident reporting, it all needs to be up to scratch now.
It's a major operational reality.
Second, that creditor protection via the collateral law. It's even stronger now. The July 15th, 2024 law cemented its global reach and legal certainty. It remains a truly powerful tool for secured finance.
A key differentiator, definitely.
So thinking about all this, what does it mean for you navigating the financial world today? It seems Luxembourg isn't just following rules, it's actively using the rulemaking process, both EU and national, to innovate and gain an edge.
That blend of strict compliance and strategic legal creativity is really its core strength.
It really makes you think, doesn't it? How many other financial centers are managing that balancing act? Rigorous EU integration on one hand, but powerful homegrown advantages on the other. It definitely poses a question about the future model for international finance hubs.
It's a unique model, for sure.
Disclaimer, this podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.